Okay, ladies and gentlemen, hope you're doing well. Just make sure that the sound is working fine for you. Do let me know if the sound isn't working well, if it's not clear, and then I'll try and change and edit it for you so you can get a better sound quality. Hopefully everyone can see my screen. We've got quite a bit to go through with the Canadian inflation data that we have coming out in about 30 minutes or so. But let's get right into it. I know we've got a bit less than a minute left till we actually start, but I think the stuff that we need to cover, we'll give it a start now. So, what is the CPI data? So it measures the prices that consumers pay for goods and services. And why is it important? So it's the main reason why it's important is because the Bank of Canada follows the headline and core inflation readings. Okay, so you have the CPI month on month and year on year data, and then you have the core inflation data, which is the median CPI data that we get from Canada, from what we get today. So again, why it's important. Bank of Canada keeps an eye on it, and then a lot of what we've seen in the past as well is that the Bank of Canada has cited that high inflation readings could lead to stronger actions. Of course, with the labour market being quite strong as well, that's also another reason why the inflation reading is quite important. J Rod says, "Hello, I was trying to register a Financial Juice website and kept saying username was taken. Used like 20. What? It's like it can't be that. Thanks. That will if you email, I'll put in an email to try and sort it out. If you email Amar at financialjuice.com, he can deal with that there for you. But yes, so going on then. So other than why it's important, so how does it affect the markets? So with currencies, a high inflation reading is generally bullish for the Canadian dollar. That means that the potential for a rate hike is stronger if inflation is picking up steam or is well above the bank's target, which is 2% of inflation. And then for bonds, usually when we're in a tightening cycle as well, high inflation reading can lead to high yields. Of course, again, it's the thought that the central bank, the reason being is that the central bank is seen as more inclined to rein in inflation and tame it or cool down the demand by raising rates. So whenever rates are raised, the central banks have a play in the short-term rates the most. Okay, and the longer-term bonds are left to the investors and traders to have a play in the markets more so than the central bank does itself. So in this regard, when of course we've already had our hikes from the bank, hike from the Bank of Canada, and we'd seen the yields before the rate decision had came out. We'd seen that the markets had started to price in further rates hikes. So you'd start to see yields going higher as well for government securities or government treasuries. That is open for everyone to trade and invest into. So from that we had seen that it led to higher yields with the inflation readings in the anticipation of stronger or faster tightening of monetary policy and maybe larger rate hikes being taken into consideration. And then for stocks, high expected inflation read in a tightening environment from the central bank can lead to a depreciation in stock indexes. And we've seen that not only in Canada with the TSX, but we've also seen that within the US as well, where the expectations for rate hikes or larger rate hikes and more rate hikes coming out or coming through the year, expected through the year, has led to markets pricing in again these rate hikes and leading to depreciation in the stock indexes in the US. But we've also got to consider as well in other nations and other areas too within the European Union that there could be the first rate hike by 25 basis points in July for the ECB. So you've had traders comments. I believe it was Villeroy who said that yesterday. You had the euro dollar starting to move, had seen some movement towards the upside in pricing in a rate hike for this year in July. So you'd seen the euro see some strengthening there. Scotch and Stocks says, good day. Hello, good day to you. You've got a buffering and a dab emoji on there. Maybe you're buffering, dab, and having a good day. I hope you are. Thank you for joining again. Good to see you. So yeah, so for stocks in a tight environment, it can be negative or bearish for the stock market, for the Canadian, for Canada. Then the previous report then, so we'd seen that we're at a 30-year high, and that was the fourth consecutive rise in inflation data that we had seen from Canada. The month-on-month was the biggest 1-month increase since Canada introduced the federal sales tax in 1991. Again, showing that inflation being quite hot on the month-on-month figure. But the key thing to bear in mind, and I think is quite obvious now to a lot of traders and economists and investors, is that the gasoline and energy has been the largest contribution to inflation readings, not only in Canada, the US, the UK especially. We had the inflation reading come out today, where inflation jumped from 7% to 9%. The expectation was 9.1%, but again, from an economic standpoint or an economic view, not from a trader's view, or maybe also from a trader's view too, in the long term rather than the short term. Again, inflation has seen a pickup, or quite a large pickup, due to the energy issues, and also factoring in that in the UK you had the price cap raised as well for energy use in the UK too. So that was also a contributing factor to that report there. But in the Canadian report, we'd seen that gasoline prices were the largest contributor to both month-on-month and year-on-year gains in prices. So we'd seen that so it was the new report showed 39.8% versus 32.3% year-on-year. And the core CPI or median CPI jumped to 3.8% from 3.5%. Scotch and Stock says, but it seems like it was held down because of the price cap. So one thing we've got to remember is that when the price cap increased, consumers were paying, having to pay more money for their energy use, right? So because the prices are raised, that had also led to higher inflation from the latest report that we had seen. So that's one thing we've got to consider. Hopefully, at some point, we get hopefully that kind of that plateaus, and then we don't see any further soaring energy. We don't see any more energy caps, or from the energy cap affecting the CPI data in the UK. But again, we'll go through that when we look at the Bank of England, and we prep for that. So we go in a bit more detail. Scotch and Stock says, yeah, now we should be balancing again. Hopefully the BOV hikes rates. And it's not out of the question too with that. But again, we'll go through that later when we do get the Bank of England rate decision next time. So the Bank of Canada's views then. So Macklem in April told lawmakers and that authorities were caught off guard by the durability and pervasiveness of supply chain limitations and their effect on inflation. The Ukraine conflict resulted in higher prices for fuel, food and other essentials. Don't forget, it's not just gasoline and crude oil prices that having an effect. It's also agriculture as well. So wheat that's had seen all-time highs during the peak, or during the period of the peak of the Ukraine crisis. So there's also those other areas that inflation has affected, not only, of course, Europe, but also is having an effect in Canada as well. And then Macklem admitted that we did make some mistakes, i.e., similar to the US, that they could have done more to raise rates, to start raising rates or tightening policy sooner, rather than leaving it to inflation getting too out of control and getting out of hand altogether. So, nonetheless, you also had Bank of Canada officials saying that they're sure that they can hike rates and get inflation down to the 2% objective, while maintaining 4.2% growth this year, and then seeing that growth declining to 3.2% in 2023. Macklem stated that officials may raise interest rates by another half point in June. So to try and dampen these inflation expectations, it's expected that they're going to be taking this stronger action to rein in inflation, and also the jobs market too, make sure it doesn't get too tight or wages spiral out of control. So half point hike has become the new 25 base point hike from what we've seen so far. What some economists view these rate hikes that are coming in from other central banks as well, including the Bank of Canada. And then you had Bank of Canada's Gravel saying that inflation pressures are more tenacious than expected, and 1% policy rate is too stimulative, especially when inflation is running significantly above the top of our control range. So be prepared to be. So there, Gravel saying that he's prepared to be as forceful as needed. So nothing. Now it's not really a surprise that central banks are going to be tightening their monetary policy even further, or being more aggressive. So a lot of the pricing, there's a lot of pricing in that has happened, as said, with not only in the US with the stock market and the yield market and the dollar as well, and gold's reaction, but also as we've seen recently with the Canadian dollar as well. But there's other factors that have been helping the Canadian dollar, which we'll go through in a little bit. So where is the economy at the moment? So inflation rate at 6.7%. Again, as said, fourth consecutive rise, the highest in 30 years, and high since 1991. GDP quarter on quarter annualized at 6.7%, which is above the Bank of Canada's expectation, which was above the Bank of Canada's expectation for GDP growth, which was around 5.8% that they're expecting for Q4. So versus the prior of 5.4%. The recent employment change data that we had from Canada about a couple of weeks ago. So we had 15k jobs that were added versus 72.5k. So still showing that there's growth in the jobs market, but was weaker compared to the previous month. Average hourly earnings had seen a slight decline to 3.4% versus 3.6%, and the unemployment rate fell to 5.2% versus a prior of 5.3%. And then again, as said, we have the overnight rate, which is at 1%, which we had seen at 0.5%, and then we'd seen a hike in April 13th, the biggest in 22 years. So again, just to reiterate that that being done, the first half point hike in 22 years takes quite a significant amount for the central bank or a central bank to do that. So again, adds to bullish sentiment for the Canadian dollar, which we have seen in the past as well. And if we do get a stronger inflation reading, we could see potentially further movements towards the upside on the Canadian dollar. Then triggers then. So according to economists, they see a high of 0.7% with a low of 0.2%. Year on year, they see a high of 6.9% with a low of 6.3%. And then, so if we're looking at our forecast for today, then, so Canadian CPI median estimate of 0.5% with a prior of 1.4%. So their economists are looking for a 0.2 deviation on the figure as their high estimate. And the Canadian CPI year on year expected to remain unchanged with the median estimate at 6.7%. So if economists are looking for inflation to moderate slightly or not to grow too exponentially, I think if we get a much larger than expected figure, and we'll go through the deviations in a little bit. If we get much larger than expected figures with inflation data, both the month on month and the year on year, then that could add to some bullish sentiment for the Canadian dollar. But one thing to be aware of, and I think it's quite key to understand, is the surprises that we can get. So when we had the UK inflation data today, the forecast was 9.1%, but it was just shy of that at 9%. Okay, so what I want to do is I wanted to show the reaction that we had seen. So inflation, yes, from an economic standpoint, economic point of view, had picked up by 2%, but was, as said, shy of the 9.1%. So it wasn't as strong as expected from an economist's point of view. But if I go through the market reaction, so this is what we'd seen on cable, right? Where, as said, data wasn't as strong as expected or stronger for the CPI year on year. And in turn, what that led to at 2 a.m. Eastern time was a movement towards the downside instead. So traders were thinking, okay, inflation may not be as strong as economists were expecting. So that's what led to the decline here. And my thinking is this is similar for the Canadian release. If we do get a negative reading in the CPI year on year or the month on month, we could see some extra volatility coming into the markets, or where we could see some more, where we may get a similar reaction again. Just looking at what we've seen with the UK data, of course, there are more bits of data within the report affecting the inflation report itself, but we could potentially see a similar reaction as we had seen with sterling against other currencies. But again, we'll see what happens with the Canadian inflation data today, whether both figures come in as expected or much higher than expected. So that goes through the economist point of view. Then the markets. So we had seen on Thursday last week. So you had the 2-year yield spread tailing the counterpart by 6.8 basis points versus 8.2 basis points on Thursday. The 10-year yield spread was 4.6 basis points. Was in favor of Canada compared with 6.2 basis points in the prior session. So yields seeing that pressure or seeing that extra amount of volatility coming through is what you need to take from that little bit there. And then there is more. Again, there is the expectation of stronger rate hikes to be taken by the Bank of Canada to try and rein in inflation. And then last Thursday, you had, following a 6-day losing streak, Canadian shares recovered as technology and energy firms climbed after the Fed suggested that interest rate hikes may not be as large as predicted as recession fears mount. So off the back of that, the S&P or TSX composite gains were up by 2%, which was its greatest gain in more than 2 weeks, which lifted out of correction territory. So just to bear that in mind with the TSX and what we've seen with the index. And then you also had, in regards to Fed's Powell as well, he said that we think it will be appropriate for there to be additional 50 basis point rate hikes at the next 2 meetings. He'd also dampened down the expectation While some traders were looking at a 75 basis point hike as potential later on down the line this year. But he said that that's not on the tables and it's not up for consideration. So that had also dampened expectations or dampened sentiment for the dollar. Okay, stronger or unexpected rate hikes or unexpectedly strong rate hikes leads to a stronger currency. But in this case, the markets have been able to price in these other 50 basis point hikes, and you don't see stronger moves from the dollar to try and price in larger rate hikes. So similarly with the Bank of Canada, then no communication has been made as to whether or not there'll be stronger rate hikes or not, but just a confirmation that there would need to be a half-point hike in June. So, investment bank views. So on April 20th, when we had the last CPI report, so CIBC, they say that some experts believe that the March statistics may represent an inflation peak owing to a modest drop in energy prices. Nonetheless, the economist Grantham believes that any easing in the coming months will likely be very modest due to supply problems arising from the Ukraine crisis and China lockdown measures. Of course, now that the lockdown measures have alleviated and China's economy is coming back into the fray, there's going to be a pickup in productivity and also consumer spending in China too. But back then, that was the current sentiment, that the Ukraine crisis and China lockdown measures were having an effect on the market overall. Then yesterday, you had Scotiabank saying that the Canadian inflation report might add positive momentum to a resurgent loonie, perhaps distancing itself from general swings in risk appetite. So what they're saying there is that the inflation report will come out, and you will see the short-term volatility or the market reaction coming in with the report for the Canadian dollar. But then again, what could happen is that could just fade away, and we'll be left to the rest of the market trying to price in these rate hikes and tighter monetary policy for the future. And in their view, saying that if the dollar CAD can hold, this is yesterday, so if the dollar CAD can hold in the lows of 1.28 ahead of the CPI release tomorrow, they write that higher than consensus expectations report should help push dollar CAD back towards the lows of 1.27 zone. Okay, so let's have a look at the deviations then, what we're expecting, what we've seen in the past. So this is something that I've sent to you guys in an email. If you've subscribed to our mailing list, the reason being it's better for you guys to understand how the markets, how currencies have reacted to these releases, and you're able to digest it with more time. And this is something that I send out on a Sunday. So I'll put in the link to sign up to the mailing list soon, and then you guys can go ahead and look at that. But we'll have a little quick look at it here. So when we've seen in the past, when data has been positive, or when we've seen at least a 0.3 deviation from the forecast figure or figures for both data, so we've seen that the strongest reaction out of all the other currency pairs was GBP CAD. Okay, so back on February 16th, we'd seen about 26.5 pips down, and then again it was the strongest mover in the markets on March 16th with 13.8 pips down, and then we'd seen a recent last month as well, April 20th. So again, it's seen about 23 pip moves, 23 pip move towards the downside. So that's what we've seen historically. That GBP CAD has seen a stronger move pip wise in the markets, and then we see that the Euro CAD takes second place overall, and then it goes to dollar CAD, CAD JPY, and the other currencies or the commodity based currencies for the Aussie dollar CAD, Aussie CAD, and New Zealand CAD. But again, as said, GBP CAD was the stronger mover last time. Now, when we had a 0.5 deviation, and data was much better than expected overall as well. Or when we had strong data from Canada, we'd seen stronger movements in pips compared to what we'd seen when we'd seen a 0.1 deviation, and data was more or less in line with data was overall positive. Or even with a 0.1 deviation, yes, we'd seen some positive moves for the Canadian dollar, but it wasn't as strong when we had at least a 0.5 deviation for when we're looking for really strong moves in the market there, or stronger moves in the market. I think one thing to bear in mind though, if we do get negative data, or if we do get a mix of data where we see CPI month on month as higher, or CPI year on year is higher, and the other one as lower than expected, I'd expect some more volatility, potentially some whipsawing in the markets, or as what we've seen with the CPI release here, if inflation is seen to be not as strong as expected, particularly with the year-on-year data as well, then, as I said, we could see a similar reaction to what we've seen with sterling. But again, I think we've had a lot of positive readings in the past, so we're yet to see what sort of reaction we could get from mixed data for Canada. But that's something just to be aware of what we've seen in the past, and hopefully that kind of makes sense for you there. Okay, so let's go through we've got about 5 minutes to the release. So I want to actually show you the previous release we'd seen, April 20th. So about 10 seconds before the release, and then there we go. So that's tick strike going off there, about 3 seconds. So data was much better than expected with a 0.5 deviation there. CPI year on year, a 0.6 deviation. We'd seen this a stronger initial reaction from the Canadian dollar overall, or stronger appreciation from the Canadian dollar. Didn't see a huge big old shoot towards the upside, but we had seen that reaction where if data is positive overall, then you would expect the Canadian dollar, from what we've seen previously, to see an appreciation as such. So if we kind of go forward a little bit, and if we skip ahead. Okay, so the reaction didn't last. From what we can see, if I kind of zoom in, keep going. So about 10 minutes after the report, we'd seen on the dollar CAD that it had erased its initial depreciation. Similarly, on Aussie dollar, we'd seen a similar reaction there. EuroCAD was still seeing some movement, hadn't completed its reversal compared to the other currency pairs. But then, if we keep going, it didn't really completely wipe the floor at all. It just kind of, we can see if I go forward, we can see that it kind of hovered. It did try on the other currency pairs to move back to its prior release levels, but we didn't see that happen. Again, this is more than nearly 15 minutes after the release on the dollar CAD. So again, could we see similar reaction from what we've seen today? With what we see today, we'll keep an eye out there. Keep an eye out for it. But again, stronger data kind of kept the markets, or kind of kept the Canadian dollar quite strong compared to the other currencies, even though we had seen a quicker reversal, or quicker move towards the upside on the dollar CAD. Okay, right. So time for the release. We've got about a minute left. Well, not too long left. Let's get our tick strike going. Okay, so GBP CAD. Let me unlock that. I'll move that out of the way. Where's my other USD CAD? Right. get that here. Okay, let's get the right. Okay, just move that way. That's a bit better. Right, so we've got a lot of data coming out with Canada. 30 seconds. I think let me add in another one. Let's add in EuroCAD too. Okay. All right. Okay, hopefully you guys can see that. 0.6, that's higher than expected of 0.5, higher than forecast of 0.5. Canadian CPI coming in at 6.8%, 6.8% higher than the forecast of 6.7%, much better than expected. Inflation readings also for the median, much better than expected at 4.4% compared to the forecast of 3.9%. So we're seeing here from the Canadian dollar, seeing some strengthening there. From that overall positive data, didn't get a 0.5 deviation on the headline figure. We'll see how many pips we get on the dollar CAD, CAD JPY, and GBP CAD, and also Euro CAD too. That's also what I want to keep an eye out for. So data still showing that inflation is strong, and overall is still stronger than expected, than economists were expecting. So again, CPI year on year, economists were expecting it for expecting no change, but then we had seen that coming in slightly better, 6.8%. So overall, Canadian inflation data much more positive than expected. Okay. So if we measure these pips now. Okay, so if we look at GBP CAD, that was, as said, the stronger mover, or the strongest mover last time. Looks to be the same here as well. Okay, so that was about, all right, so not as strong as the previous report, but still about 19 pips towards the downside. Let's look at the EuroCAD, which is the second strongest currency pair, which is seeing the second strongest move. All right, here we go. Okay, so that was about 14 pips towards the downside. Okay, and then dollar CAD. Take a look at it there. That's about 15 pips. So about 15 pips there. Okay, so as said, data was better than expected overall. Saw about 19 pips on GBP CAD, which was the strongest mover pip-wise so far. We also want to check CAD JPY. See if we got a similar reaction or how strong a move that was. Okay, that was about 11.5 pips on there. Okay. All right. So there we go. other than that, let's right. Okay, so that was the release there. Other than that, I think, yeah, there's nothing really else. I think we'll have a quick look at the report too. That'd be a good idea to have a look through a bit more detail. So food and shelter prices had seen was the main attribution to the year-on-year increase. Gasoline price increases were lower in April than in March, dampening the growth in all items and CPI in April. Excluding gasoline, CPI rose 5.8% year on year, which was the largest increase in the special aggregate of all items CPI excluding gasoline since its introduction in 1991. Still, the Russian invasion of Ukraine is having an impact on the report too, in the government's view. So, continue to influence energy, commodity, especially food prices. So now, if you would like to, so that's basically the report there, and you can see that on the feed on Financial Juice. I'll leave TickStrike running, but the key thing is for a trader is to be able to stay ahead and stay up to date with the news. Okay, investment banks use a squawk service or live voice and text service to manage their trades, and also sometimes to be able to take trading opportunities as well. So having a squawk service is key to every trader. Okay, this is high level stuff that is not readily available to every single trader globally. As said, more or less, it's more with investment banks that have this access. So why is a squawk important? Well, there will be certain headlines and certain releases that will come out, such as the inflation data that we had from the UK, which when we say it on the microphone is near enough on point or to the second when the release comes out. And part of what we do as well, of course, you get that data coming out legally split on the website too. Okay. And then what we also do is put in the market reactions. So if you are looking at, we chart that data for you too. So if you are looking through the feed or what's happened with previous releases, if there has been a major move in the markets, then you can see that on the Financial Juice website as well. And then again, so similarly for the Australian Wage Price Index, what we had last night, which was in line with the prior, but less so than the forecast figure. And again, if you're not up to date with what's going on in the news, then that could be a detriment to how you trade. Right? A lot of the times, news will move the markets, and I'll show you why. Okay. So as an example I used last week, and I'll use again recently, where we had von der Leyen saying that they'll phase out Russian supply of crude oil within the next 6 months and refined products by the end of the year. We had seen that move towards the upside in WTI crude oil off of the back of expectations of the less supply being of less Russian oil being used. So from that, we had seen the positive move towards the upside for WTI crude oil, and that again was off of the news that had come through that we had put out to the website for our traders and listeners as well. So that's why it's quite key. If you were unsure of why is the market moving this way, why is the S&P 500 seeing a load of movement towards the downside, well, there's sentiment that is involved with it, right? And that's one thing that, as we've kind of gone through with today, that central bank tightening is the key sentiment, but also how Europe is dealing with the Russia or the Ukraine conflict too. So overall, I think it's very key for a trader to have. So what we want to do for you guys is provide a 7-day free trial for you to try out Financial Juice Pro. So the difference between Financial Juice Lite, the free version, or the Pro version, you don't get any adverts. You don't get any 10-second delay on the whole website. And in the Pro version, you're able to add in your economic release triggers. So what do I mean by that? Let's say if you were looking to trade the Canadian data, you would put in your buy and sell alerts manually, okay? And when the figure matches, matches the data or matches your trigger, it will show up with a little buy or sell signal, whichever way you're looking to do that. So that's also real time too, whereas on the light version, that's delayed. So again, live voice and text, which is run 24/5. Okay, no adverts, no delays, and you also get you can also see your economic release triggers in real time that you set for yourself. So that's Financial Juice Pro. And if you've been looking at TickStrike going off in the background too, then you can see, so TickStrike is used to gauge order flow. So imagine you're in the trading pits and you've got these people, and you've got the markets are about to open, and all the guys and gals decide to open up. The trading is opened, and they start to shout, buy, 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 sell, 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 sell at this, blah, 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 right? All that noise is translated into TickStrike here, right? Visually and audibly as well. At the moment, I've got it on mute. I don't have the sound on, but what it will do is it will let you know how much buying or selling that there is going on, or the momentum of buying or selling, and how strong that is, right? So at the moment, we can see selling on CAD JPY, and EuroCAD, a little bit coming through there. Okay, that's wiped out. It's GPCAD still down compared to the other currency pairs. Near enough, dollar CAD and EuroCAD have erased their initial move towards the downside, and CAD JPY has erased its initial move towards the upside. But yes, so for the currencies, or not only does TickStrike cover currencies, but it covers stocks, stock indexes, mainly all the futures, and also bonds as well, that you can also keep an eye on for, and commodities, gold, your crude, your silver, and your natural gas as well. So it covers a wide range of different products, different assets that you can have a look at. So what you can do, interestingly, is with the setting. So if you don't want to see TickStrike going off all the time, so I've got mine set at level 1, i.e. I'm looking for a lot of sensitivity in the market. I'm looking for sensitivity in the markets, right? And I've set it to 1. So any sort of move that matches or meets the requirements for TickStrike to go off, then that will kind of show here what we can see so far. So, but what I can do, if I want to see extreme volatility or extreme amount of momentum that's going on within the markets, then I can up that level of sensitivity to 15, which means that when there are extreme moves happening, then only then will it go off if it meets the requirements that are set for the ticker. So 1 being the least sensitive, 1 being the most sensitive, and 15 being the least sensitive. Okay, so that's TickStrike there. I've put in the trial. I've put in the 7-day free trial they can get off TickStrike in the chat as well for you. Also, don't forget to like and share this video, and also subscribe to our channel if you enjoy the content. But also, if you want to sign up to our mailing list as well, to get the deviations, to be able to get an idea of the week ahead of what to expect, then so the week ahead, so this is what the week ahead kind of looks like for you here, that I prep for you guys. That the that I put out every Sunday, the releases to expect, what is being said and what is to be expected news-wise, economic release-wise, and what to expect as well for you guys on a Sunday. So if you want to sign up and keep in touch with what to expect the week ahead, and also be able to look at the deviations, and sign up to the mailing list. It is there for you in a link. All right, so GPCAD still hasn't erased its initial move towards the downside, whereas the other currency pairs have. Dollar CAD, Euro CAD, CAD JPY have reversed. Dollar CAD and Euro CAD have reversed their losses, and CAD JPY reversed its gains on after the release. So next we have the EIA inventories coming up. Don't forget, you can join me at 10 a.m. Eastern time for the prep for that. Again, there's not a lot of sentiment compared to what we've had previously to go through, but we will be doing that prep there. Other than that, thank you very much, and I will see you next time.